Fantastic. All right. So as I was saying, EIA. Oh, there it is. Okay. So you can get the current one up. July 16th. Sounds good, right? Let's see. So, bloody, 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 blah, bloody, 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 blah, 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 blah. Okay, commercial crude inventories increased by 2.1 million barrels from the previous week. Oil inventories, blah, blah, blah. All right, gasoline inventories decreased by 1/10. Is this the right one? Yeah. Distillate fuel inventories decreased by 1.3 million barrels. Hang on. I'm a little confused. It doesn't sound like the same numbers. Okay. Let's see. This says, oh yeah, crude up 2.1, right? So crude is up 2.1. Gasoline is down. Last week it was up. Distillates are down. Last week they were up. So this is what they're focusing on, the fact that we have a draw in gasoline, tiny though it may be, and a draw in distillates, which is not so exciting, even though it's offset by the, when it's funny because if the draws here are offset by a build here, they pay no attention to the build. But if you have a build here and a build here, and it's offset by a tiny draw here, they think this is the only thing that matters on the report. So it's just a matter of convenience. But the encouragement in theory, again, it's all theater. But the encouragement here is that you do have a draw where last week you had a build. So they're saying, oh, that was a little dip in demand and that was temporary because they were freaking out last week and oil fell off a cliff. In fact, if we look at the bigger chart for futures on oil. So, well, that's not daily. Actually, it was daily, but it doesn't show you a good view. Okay, so here's what happened last week. And let's see, this must have been Monday, Tuesday. So here's Wednesday. What a disaster, huh? Fortunately, we were betting on this, but it was great for us. It was terrible for bulls. But it went from 75, which was our shorting line, all the way down. Eventually, we were out, but all the way down eventually to 66. I mean, that's just, and it finally hit 65. Since then, we bounced back, and now we're in the middle. And I was just saying to somebody in the chat room, it's just not bettable now. I mean, that's it. Now we're in the middle of the range. We don't give a shit. I like to short it when it's short. We could have gone long here. We knew 65 was going to be bouncy, but I wasn't really in the mood to play it long because you don't know how bad it's going to collapse. If that had failed, it could have gone much worse. But the thing is, 75 was just so toppy and so fundamentally wrong that it was an easy bet. That's why I like to bet it. At 70, I have zero opinion. It could go up, it could go down $5. Why take the chance? It's not worth it. Although I did just make a play in chat, and I said, if you want to chase something because you feel like, oh, I could have made a day trade on that, do Valero. Because Valero, you can pick up the August 60 calls for $6, and we were at 60. That would be 66, and we were at 65.15 at the time. That's what it was. So 65.15 to 66 is 85 cents. So there was 85 cents of premium, which is not very much. So you're going to get almost all of the move up from here. And all you have to do is commit is to put $6 on the table. So 10% of the cost of the stock, and you can day trade the thing. And I said, if you just make a stop at 65, what are you going to lose? A quarter? It's not a big deal. So you have a nice tight stop. You're going to lose. You're risking you're putting down $6, but you're only going to lose a quarter if you pay attention to the 65 line instead of stop. But if it does continue trending up to 70, and if oil keeps going up and gasoline keeps going up and it trends up to 70, you're going to make $5, or at least $4, even if the premium collapses. So if you're going to make $4 On 6 is 66%. Who doesn't want that? So, you don't have to be the first one in to day trade and whatever. Notice we have that classical M pattern, right? And it's kind of completed itself. I mean, I'm on, if you want to measure it, 55 to 80. We'll call it 85. So say it's 30 up and we're not quite 30 down. So we went 25 down. So we have a shorter leg here than we had before. But generally, you've completed basically the M. And now you're going to go here and we'll probably get a W. So it's probably going to go up a bit and then back down and then back up. And back up would take us perfectly into the holiday weekend next month. And then we can collapse again. And then you'll have the much bigger pattern that goes from here and makes an M and goes to here and goes down. So that'll be fun. But you got to be patient and wait for it. We certainly, I'm sorry, that's Valero. I mean, oil is going to be more predictable than Valero. Let's take a look on the oil chart. Oil does not, you don't have as much of a pronouncement, but here you go. You're making the same thing. You're making the M. You get back up here and come back down here. Same thing, back up here for the holiday. Back down. So we're going to be loving short in 75 again. And then after Memorial Day, I guess we have in September, right? Labor Day is May. So Memorial Day is the end of August or the first week of September, whenever the hell you have that thing. And then you got nothing. Then you got September doesn't have a big, I mean, other than Memorial Day. You have that holiday. Then you have October. Halloween is not really a travel holiday. And then you got nothing until Thanksgiving. And Thanksgiving does not tend to be a huge oil-based holiday where people travel, but not. It's weird. I don't know. I mean, it's just you would think it's more of a travel holiday than it is, but I think it's because everybody's home. It's not a hotel holiday at all, right? So everybody's home. Some people go to somebody else's home, but it doesn't end up being a big consumer of gasoline. Neither does Christmas, actually. And again, because Christmas people go home, they go to somebody's home and they stay there. They're not like out really traveling much. So I mean, there are a lot of flyers and so on and so forth, but it's not the same as the travel holidays during the summer where everyone is leaving their home to go elsewhere. Speaking of traveling, we're not going to have a webinar next week. I'm going to be in Orlando. So next week I am in Orlando and not doing a webinar because I hate, they always too many problems from a hotel. So I prefer not to. Plus I should, pay attention to my kids. That's why I'm there. I'm not there to like work supposedly, but I will work. Anywho. So what we're seeing about the EIA. So yeah, anyway, it's a load of crap at this point. It's just an excuse to try to push it up. I mean, okay, hang on. Okay. OPEC oil production chart sort of thing would be nice. Wow. April 2020. Up. Tools, time, past month, past week. Let's see if anybody's got something really up to date. Global crude. World oil production. Well, see, here's one thing, it's surplus crude capacity, but let's see if we can get this thing right first. Well, that's the increase in production. This isn't telling us crap. La-di-da-di-da. Okay, well, as a proxy, this is what OPEC took off. This is OPEC's surplus crude production capacity. So In 2019, their surplus capacity was 2.5 million barrels a day. That's before this crisis. They could make 2.5 million more barrels than they were actually making. So they were already withholding production because they wanted to keep the prices up. Weren't doing a good job of it. Prices were pretty low, but they were trying. In 2020, they had the excuse to completely curtail production. Again, politically, it's very hard to like take this much off the market. They make about 30 million barrels a day. It's almost 10% of their production. They're keeping offline in order to jack up prices around the world. So now they went from 2.5 to 6 and getting to 6.5 in 2021. Now they have agreed to start putting it back on the market, but only at 400,000 barrels a month. So if they're at 6.5 million extra barrels, just to get down to 2.5 is obviously 4 million barrels, right? It's going to take them 10 months of 400,000 barrel production increases just to get back to where they still have a 2.5 million barrel surplus production capacity. Okay, so meanwhile, what does that mean? So meanwhile, back in the United States, where we find the EIA report there, okay, so back in the United States, what do we have? We have a net, well, it was over here. We have a net 2 minus 1 minus 1. So we have a net build in the United States, and we consume about 20% of the world's oil. Yet we're having a net build even though OPEC has 6 million barrels a day, not a week, a day offline. So if they put 4 million barrels back on the market, where's it going to go? And it's not just us. We're just typical of Europe has the same thing. Russia has the same thing. Asia has the same thing. The world is still not using this capacity of oil. The world still has a tremendous surplus. And of course, OPEC is only 30 million barrels a day. They're only 1/3 of the market, and they have cut 20% of their production back. So other countries, Russia is technically part of OPEC. I'm not sure if that wouldn't be counted in that production cut, though. South American countries, U.S. producers, we cut back tremendously. In fact, you're not going to see it here. Shoot. Ugh, that's annoying. Because last year we did. But 20 million is pretty low for the U.S. and the input to refineries, 16 million barrels is lower than we were before. And we're exporting. Again, we import 3 million barrels. We export 2.8 million barrels a day of product is being exported out of the United States. That's 21 million barrels a week. That's 1/2 of what OPEC has cut back. We are exporting and we still have a build in product. We still have an overall build in supply of oil. Went from 1892. In fact, look, it's even worse than it looks. We went from 1892 to 1896. So what's that? That's this thing. See all other oils? That doesn't count on the EIA report. When you see it, you don't see this because it only highlights oil, gasoline, and distillates. It does not tell you that all other oils, the thing it doesn't count, is manipulated. And how does that work? The refineries make these other oils, and they take them up in volume because they know they can dump oil into those. They're taking oil barrels, opening them up, making stuff that maybe nobody wants. But what's the difference? Because if you don't track it, it doesn't look like an inventory build. And that's how they give you the false impression that there's some sort of demand. There is no demand. And, not to get into it again, there's a very short story about this, but factors are obviously less travel from COVID, especially cruise ships are off the table still. Very, very few cruise ships going out. They are massive consumers of gasoline. We don't have any wars going on. Wars are huge consumers of oil also. When we were doing the Afghan war back in the Bush days, we were using 1 million barrels a day just to fight a war. Just the army over there was 1 million barrels a day consumer. So we don't have any major wars going on right now. So these oil guys should start one up. And also the other big factor in this oil thing is, of course, the vehicles that are coming out. More electric cars, more high mileage cars. Biden put the standards back up. We simply, every time someone buys a new car, the chances are they're moving from a car that got the low 20s in mileage to a car that gets in the mid 30s in mileage. So they're getting a 50% boost in mileage, which is a 30% decrease in the amount of gasoline that car uses every single time. Now, if everybody in America tomorrow went and got a new car, that means that we would then use 7 million barrels less oil per day. And then you'd have a bill, because then they kept sending us the oil, or if we kept if we kept pulling it out of the ground here, or OPEC sending it over, we'd have a 7 million barrel per day, 50 million barrels a week build in oil. And that'll obviously won't happen tomorrow, because it takes time for everyone to buy a new car. But will everybody buy a new car? Yes. When will everybody buy a new car? Within 10 years. So what's going to happen over 10 years? Over the course of 10 years, every single year, not 7 million barrels a day, but 700,000 barrels a day less oil will be consumed in the US. And I know it's a simple, and obviously not all oil consumption is cars, but it's the same thing everywhere. Everybody, everywhere, everything, they're doing whatever they can to use less oil, because you got to burn less fossil fuel, you have to increase energy efficiency, and so on and so forth. So it's not just autos, but autos are the example that says, hey, here's something you can definitely save. And that's why all these oil countries are on a real treadmill to hell, because demand is going down and down and down. We are not replacing, and that's another thing. We had very low birth rates during this virus here, and that's has not helped increase world population. So we're not we weren't increasing the population much in the first place. We getting towards a plateau in global population. They think that overall we should be naturally declining over time now. We're at 8 billion people now. They think the world will peak out at maybe 10 billion people, but after that we should go into a bit of decline. Like Europe is in decline now. Europe has a declining population. And as the rest of the world ages, not ages, but the civilizations age, we could have less and less people as we move forward. So you don't have a robust population growth in any case. You don't have a robust demand growth, because we've been consuming oil in a very inefficient manner, and we're getting more efficient at it. And also, we are moving to replace oil in a lot of ways. And in fact, one of the things we're doing, one project at PSW Investments, is we have a hemp manufacturer, hemp farms, that are going to be converting the hemp to plastic. And hemp is a almost total replacement for plastic. There's almost no kinds of plastic products that can't be made from hemp. And that's going to be a huge industry. First of all, that's a good thing. But it's also going to be saving roughly, I think it's something like 10% of the oil that's used in America goes to plastic manufacturing. So you're talking about massive amounts there also. And again, we're not going to save it all tomorrow. It's not going to disappear overnight. But all these little things, if every single year, even don't forget, this is per day. Even if you take half, even if you take 350,000 barrels a day offline every year, that still is times 7 is 2 million barrels a week less demand. And it grinds down. And the biggest problem these OPEC guys have, and this is why they went to sell the shares of Aramco, because Aramco has, the biggest reserves in the world. The reason they wanted to sell the shares in Aramco and start taking it public is because they don't want to be left holding the bag, because it's very possible that the oil that is still in the ground will never be taken out of the ground. Not all of it, obviously, we're still using it, but the vast amount of oil that's still sitting there that everybody kept saying was going to run out one day, now they're worried that nobody's ever going to want it, that it's just going to get left there as demand dwindles and dwindles and dwindles, and you're never going to tap into these massive reserves they're sitting on. And these guys count on that money. They count on that revenue. It's a whole freaking economy still. And as much as you've been telling, as much as we've been telling the Arabs and everybody else in the OPEC states to diversify their economies, not many of them really have. I mean, you got Dubai has really moved into finance and so on and so forth, but most of those economies are still very, very oil bound. And with like 80% of the revenues coming from oil. And that's devastating if you think that down the road, people aren't going to be using it. In fact, there's an article on the weekend, which was interesting, that apparently the Saudis, with either the Emirates or Saudis, one of them, with their investment fund, they invested in one of those electric car companies, and they made $20 billion because they put their money into an electric car company. I don't think it was Fisker or somebody else, but their investment has paid off massively as the value of the electric car company has gone up. But that's the kind of stuff they need to do, and that's what our other energy companies are doing. Total, who we like, who is no longer Total, they're like TET or something like that. I forget what they're called. They were called Total. They're in our long-term portfolio, I think. Total Energy, TTE. Where are they? Down. Oof, that's a lot of positions. All right, QRST. Nope. That's because they're a stock. Is that why they're up here? Oh, there you are, TTE. So Total, who is now Total Energies, they have shifted massively towards alternate fuels, solar, wind, things like that, and that's their company now. They still have a lot of energy products, but they're getting rid of it. They're selling it off. Anybody who wants their energy stuff, they're happy to sell it, all the oil stuff, and they're becoming an energy company for the future. And I think they're in our futures now portfolio. If not, they should be. But we like them for the long term because they're getting away from that. They're changing the nature of the company. We had already sold the $40 call and the $40 put, and we're right on target at 42 for them. So they're right where we thought they would be as of February. And we're getting called away this month, in fact, on this, and we're going to want to set up another position. The problem with TTE is they don't have, I don't think, long-term options. And that's why we kind of haven't been all over them. Oh, no, now they do. Well, what do you know? Okay, well, in that case, I'm going to be very interested. Oh, look at that. Okay, so you can sell these. Look at these. These are $5 to $6.50. So $5.50, $6. You can sell the $40 puts and net in for $34, which is 20% below the current price. Absolutely want to do that. Why are they so low? Let's see what's going on there. TTE. They're getting no respect. Wow, yeah, they took a real bath. They were at 50. So here we are here. This is $108 billion for market cap. And look at the profits. $13 billion. And it's been steady up. Of course, you have a bad year in 2020, but steady growth in profits. These guys know what they're doing. They're changing it. I guess they're taking on a lot of debt to make these changes, but they know what they're doing. I have faith in this company. This is crazy. So, all right, well, it's time to make a new play with Total, because this is really crazy. And now, so what would I do? Well, obviously I want them, okay, because the market cap's 107, but they're making $13 billion a year. And it's not like, oh, crazy 13. It's like 11, 11, 13, getting close to 14. Revenues, 188, 176. Forget last year, 193, 199. All perfectly normal, moving along revenues. I like their business plan. I like what they're doing. I like the management. I don't have a problem with them investing, since they take on debt, but they've got massive cash flow. They're planning for the future. So yeah, I could see why people are getting scared off them, but this is silly. I think 40 is a really solid support line for these guys. And again, we just had an opportunity because oil crashed, because this was, well, let's see a closer chart. So starting right here on June 16th, oil started falling apart. Or it didn't really, it wasn't June 16th. But anyway, whatever the cause was, they went down like this. They hit the $40 line and tested it. We weren't paying attention because we already have callaways at 40. But now that I'm looking at it, I'm like, why aren't we taking a bigger position in these guys? The perfectly good stock. We should be all over this thing. So somebody remind me later we need to do Total. But a quick look at it, as I said, for sure, you sell the $40 calls for like $5.50, let's say. And then we've got, let's say we sell 10 of them. So you're obligated to buy 40,000. And of course, you want to be proportionate to your portfolio. But whatever is appropriate, whatever amount you absolutely would love to own and happy to double down on if it goes lower. That's your rule of thumb, really, for setting up how many puts. If I own 1,000 shares for $45,000, will I be thrilled, not kind of okay with it, but thrilled to double down if it drops 50%? So if it drops to 22.50 from 45, and I've got $45,000 invested, will I be happy to put up 22,000 more dollars and have 2,000 shares that average around 35 bucks? Yeah, absolutely. Do I want 2,000 shares of Total at 35 bucks, $70,000? Yes, then I have no problem obligating myself to 55,000 now. First of all, if you think about it, I'm obligating, sorry, not 55, 45. I'm obligating 45,000 now, and I'm willing to spend 22,500 more to get another 1,000 shares. So will I be okay having 70,000 into this position and having 2,000 shares at an average of 35? I absolutely will. 35, it's a freaking 42 now. So that's like 25% below the current price. So that right there is premise number one. Premise number one, I would love to own this company if it completely crashes. And I'd like to make it a large part of my portfolio. Given that, I have no problem at all obligating myself to buy 1,000 shares at below the current price. Now I say, okay, well, okay, we're at 42, 43. We think 40 is a good base. So I'm going to look to sell like I'm going to look to buy the $40 calls. This spread is way too wide. And by the way, if the spread is too wide and you're trying to figure out what's the appropriate bid, you look at the spreads around it, and you see here we have 255, 310. So let's say 275, okay? Let's say 275, 280. The delta is 38, and you're talking about $5 here, $5 spread. So 5 times 38 is $2. So this one should be what do we say, 75. So this should be 575. Now we'll check it the other way. And here we have 720 to 9, a little harder to say, but let's say it's $8 in between. And the delta here is 78. So 5 times 80 is $4. So they should go down to 4. So the very lowest they should be is 4. And we're thinking more like 575. So if you look at this, now you have a clue of where the correct price is, probably in the, I'd say 450 to 550 range. And that means $5 you should absolutely be able to fill on this. And if you look at the pricing also, $5 we'll be paying $250 in premium. That makes sense. But then we sell these guys, and if we can get So if we can get the 40 spread for two, so if we can get this for 550, let's say, and let's say we can sell these for 150, that means we're paying $4 for the $10 spread, and we sold $5,500 worth of puts. So we have $5,500 and we have $4 spread. So if we buy 20 of the spreads for $8,000 and we offset that with 10 short puts for $5,500, then we've got a net $2,500 investment on a spread that's $20,000. And that means we have $17,500 in upside, which is a lot. I'm not doing the math, I'm just saying that's a lot. So it's a really good upside, 17.5 off a $2,500 cash investment. And our worst case is we're going to get assigned 1,000 at 45 plus the 2,500 theoretically that we lose of the cash. So it'd be 47.50. So our worst case scenario is we're obligating ourselves to buy, not 47.50. I'm sorry, these are $40 puts. It'd be 42. Did we say we're selling the $40 puts? Yes, we did. So in this trade, our worst case would be we would own the stock for 42.50, which is right where it is. So our worst possible case, if we don't roll, we don't double down, we just sit here and take the loss and get assigned the stock, worst possible cases, we'll have 1,000 shares at the current price. And again, if it goes to 22.50 and we double down, if it drops all the way down 50% to 22.50 and we double down, then our average would be 32.50. In that situation, if we just let it fall and then we double down. Again, it goes back to the question again, would I be willing to own 2,000 shares of TTE at 32.50? Absolutely. No question. Therefore, good trade. That's the logic you got to go through if you want to make a trade. It's like, what's my worst case? Am I happy with my worst case? And I know it sounds weird to say you're happy with your worst case. Obviously, with 2,000 shares at 32.50 average, it's going to be at 22.50. That's why we doubled down, right? But we're down how much? We're down $20,000 on that position. But in the long-term portfolio, we have $100,000 allocation block. So this allocation block on this position would be down 20%. 20% is recoverable. You want to try to not be down more than 20% on an allocation block because that's where you start getting into an unrecoverable territory. But 20% was always recoverable. And not only that, though, but we like Total. We think they have long-term potential. We don't mind sitting on them for quite a long time while we wait for them to fix themselves. That's how we do it. That's how we make these investment decisions. And this morning, we had a couple too. I was bargain hunting. I think I mentioned this. You guys, hey, you guys. So I look at so many stocks to come up with like one or two that are like investable, and it's a market though. I mean, look, it's shooting fish in a barrel sometimes because everything is cheap, but in this particular kind of market, you got to be so careful about if someone's worth buying, are they too much, so on and so forth. So I talked about valuation and where you get sort of a mispricing in the market from valuation. Gave an example here. You know, the S&P is out of control. This was the beginning of the year, and we're 10% higher than that. So we're here. We are here, where we have this massive crash. And believe me, in 1999, I did, and I'm not, and not to brag, but it's just I had the same logic then as I have now. I said, this is not sustainable because there isn't that much money in the world. You cannot buy Apple at $2.5 trillion. As much as I love Apple, you cannot buy Apple for $2.5 trillion and expect to get another and that's only 20%. Expect to get another $500 billion in the near term. Where does $500 billion come from? Where did $500 billion come from? How can that be their market cap? What caused that? Who is going to buy the company for $2.5 trillion? Who's walking around with that kind of money? It's not sellable as a company. It's too much money. And you add up all this money on all these stocks, and there's such outrageous numbers, and you say, what if there's a correction? What if this market turns south? Who's going to be able to buy the shares from you? Nobody, because there isn't that much money. That's what I'm talking about in this car lot example, is this guy who owns a dealership. He sold his last car for $40,000 because somebody desperately needed a car. It doesn't mean that the other 75 cars on the lot, which were going to be 25,000, are now 40,000. So we go 75 times $40,000 is $3 million. But we already determined that the entire population of this town only makes $5 million. How originally he thought he was going to sell 100 cars. Keep doing that. 100 cars for $25,000 and get 2.5 million. He already planned the population would spend half of their money on cars. Okay, maybe they will because they're not paying it out all at once. They pay it out over time, blah, blah, blah. So maybe that's reasonable. And we know from real life that is reasonable. People tend to pay something in the neighborhood of a year's salary on a car. You know, that's about what people tend to do. Maybe half a year's salary on a car, for sure half a year's salary on a car. I don't know too many guys who make $100,000 plus a year who don't have $50,000 cars. And even people making $30,000 a year tend to get themselves a car that's more than $15,000. So there you go. So he planned that the people in the town would all be willing to spend half a year's salary on a car, and the average salary may be $50,000. But of course, some people make $150,000, and some people make $10,000. Probably lots of people make $10,000, $15,000. So he doesn't even know if he's going to sell all these cars for that kind of money. It might be too much for a lot of people. But in his first few weeks of sales, it's going super well. And something causes there's a stimulus. It causes a rush on cars. People come in, they buy 20 cars. Now he sold 25 cars. He's made whatever he's made. But the problem is, what have you done? Now 25 people are not car buyers. So now, and not only that though, but he doesn't know whether or not the richest people in town came and bought these cars first, and now he's left with 75, the bottom 80%. Remember the bottom 80%? Now he's left with the bottom 80% who can't really afford a $25,000 car, and especially if the government takes away the low rate incentives. All of a sudden, this guy's imagining he's going to make all this money and he's got this incredible stock. But what happens if originally, don't forget, originally the plan was he was going to sell 100 cars for a $5,000 profit. So he was going to make $500,000. That was his original plan. And what did I say? He made $230,000. So far he's made $255,000, not $500,000. He's made $255,000, but he may have rendered 255. Oops. So hard. There you go. It's so hard to make the numbers work. So he's now made $255,000 selling 25 cars, but that doesn't mean he's going to make $1 million selling 75 cars. It just means his profits were front loaded. If you've sold to the top 20% and you made a lot of money selling to the top 20%, but they are satiated, they have what they need, you may not necessarily get what you expected from the bottom 80%. So he may have skewed his profits forward, and he may be extrapolating money forward, but this could actually end up costing him money. Now he's got to deal with only poor people coming in for cars. And they can't afford it. They don't want the Sirius XM radio. They don't want the Under Armour protection or whatever it is they sell you. You know, they don't want the leather interior. All of a sudden, they just want the basic, cheapest possible car at the same price he paid for it. So he lucked out, made a lot of money early on, front-loaded his winnings, as I always warn you guys, right? This happens in stocks too. Sometimes you buy a stock and it makes money really fast, but then it languishes after that. Why? It went to full value. Just because something goes to full value doesn't mean it's going to go to fuller value. And that's what this is a gigantic warning sign of, okay? This is 30 times earnings. It takes 30 years for you to get your money back on a stock. That's 3% per year, and that's not even compounded. So you're in a risky investment. The normal PE is 17, so it's basically half of where you are. So you're buying 100% overvalued stock. It's going to take 30 years for you to get your money back at this level. 30 years. And if at any point during that time the stock dips, your whole thing is wiped out. So how is this a good thing to buy? How do people jump into these stocks? It's crazy. You know, and it's like this cartoon. It's like, you know, it's like you say, well, obviously this is stupid. Okay, you had no husbands yesterday. You have one husband today. That means in 30 days you have 30 husbands. Why? Well, because you had one today. That's how it works. Everything has to be a graph. And then you say, oh, well, that's ridiculous. You need more data points. It says, well, great. Here's 0, 0, 0, 0, 1. That means that it's increasing at an exponential level. This is how people invest. This is TA. This is technical analysis, right? You look at the chart, you see the slope of the chart, and you say, oh, that's going to continue because it did this. It broke out of this range. Here is your trading range. Your trading range was one husband. Your high was one husband, and there's laws. There's an actual law saying you can't have more than one husband. So you've gone between 0 and 1 husbands for many years. Now you've broken out of your trading range. You've got one husband and you've broken out of your range. And so we're going to say from that, now you're going to have 2, 10, 20, 30, 40 husbands, whatever. It's stupid because the fundamentals haven't changed. You can't have more than one husband. You just happen to be at the top of the trading range. Same thing for this guy selling cars, okay? The town is out of money. What you're not taking into account is that, let's say selling houses, right? Bill Gates, very rich. Donald Trump, very rich. Elon Musk, very rich, whatever. Okay, all of these guys can buy $100 million home. Not all of them want to buy a $100 million home, but they all could buy a $100 million home. So if you're selling homes for $100 million and these 3 guys walk in, you're going to be like, holy crap, this is great. I sold 3 guys $100 million homes. I'm going to do this. I'm going to now invest in building 20 more $100 million homes because the first 3 guys I saw bought $100 million homes. You may never sell another $100 million home again. Just because something goes right at the beginning doesn't mean it can continue to go right. You run out of money. You run out of, there's just physically a limit to how much money can possibly go into the market. It's being taken from somewhere. The thing that's going on now is the government is printing money and we have no idea. There's no accurate count. There's no way to determine what's going on. The banks are playing games. The banks are buying stocks. The Fed is buying stocks. The Fed is buying houses. They buy a house. The person who gets the house money takes the money and puts it in the market. It's just money is being created and put into the market. Kids are getting checks and putting it into Robinhood. millions and millions of young people who are 18 to, let's say, 30 years old are getting money from the government, and Robinhood is very faddish and Bitcoin is very faddish, and they're putting money into these quote investments. And look, not that they shouldn't. I mean, the markets are a good investment, but you've got to be picky about it. But they're putting money into these investments because they suddenly got an extra 1,000 here. Here's 1,400 from Biden. Here's a 600 from Trump. Here comes some more money coming up. Student loan forgiveness. All of a sudden they have less debt. They get this and that. There's all this different money coming in, and these kids are like, okay, great, because investing is a big thing for kids now. They all talk about it. All of a sudden, all the high school and college kids talk about investing in Robinhood and trading and blah, blah, blah. So money is coming in from all over the place, but it's not normal. It's not the natural flow of things. And that means that all it takes is a policy change and it falls apart. All it takes is a confidence change and it falls apart. And you got to be just very aware of that. And I'm not saying not to play. And again, this is what happened in 1999. It's like I sat out all of 1999, but not by the end of 1998. I was like, this is going to die, and it didn't die. It went up another 100%. The Nasdaq was like at 2,500 when I said it was going to die, and it went up to 5,000. Then it died. Am I right or am I wrong? I'm right, but I'm too early. And I saw a lot of people making a lot of money betting on the stupidest shit. But when it crashed, there were no buyers. None. Couldn't sell it no matter what you did. You've got Yahoo at, I forget the number. I want to say 300, 400, something like that. It's like $300 a share or some such. And you have these shares at Yahoo at $300 that you bought them for $30, and all of a sudden, like, they're coming back to 30, and you can't find anyone to buy it. You try to sell it at a price, and that price gets gapped below when you put it up, and you say sell it at market, and all of a sudden it's $100 off where you thought it was going to be. Because there are no buyers. And when you see these low volume rallies and you see these incredible valuations, the low volume rally is only one part of the problem. The other part of the problem, like I said with the car example, if your last car sells for $40,000, it doesn't mean every car on your lot is worth $40,000, because there will never be that many buyers at that price. It cannot happen. And when people go to sell, now the first 25 people who bought cars, if they go to start selling their cars while you're still holding your cars, now you're competing with the people who bought the cars before you. And they start bidding down and bidding down, and you bid down and they bid down, and you bid down and they bid down, and you're all trying to get the same small pool of poor customers to buy your cars. That's how the market works. Except it's millions of shares, and there's a much larger pool of buyers, and you have institutional buyers and bankers and so on and so forth that you have to take all that into account as well. But in the simple landscape of it, it's the same thing. There's X amount of shares, a company has a certain valuation, there are so many other companies, and they all compete for your money. And that's why when you have a choice between a company that's trading at 30 times earnings or a company trading at 10 or 12 times earnings, you got to take the one that's making 10 or 12 times earnings. Not based on that alone, but that has to be a really strong factor. The fact that when push comes to shove, at least they make enough money to keep you ahead of inflation. That's the least that they can do for you. Doesn't matter if the stock goes up or down. If the company makes money, they'll survive, and eventually you'll get your valuation out of it. But not if they don't make, not if the money they make comes back to you in 30-something years later with a 30 times PE. It ain't gonna happen. You can go a decade without seeing your money again. You really can't. When a company has a sustainable 10 PE sort of ratio, it's making all the money you give it in 10 years. So what's going to happen to that money? Either they'll distribute it through dividends, they'll buy back stock or do something like that to raise the price of the stock, or they'll invest it and expand the company and make it more attractive. Something is going to happen with that money. With the entire market cap of the company, something is going to happen. Now, there are certainly plenty of management teams that will waste that money and not use it properly, and the money will not come back. They'll spend the money and have no tangible evidence of it down the road. That can happen, of course. But that's why fundamentals. What does Warren Buffett say? Warren Buffett says, I only buy management. I don't buy companies, I buy management teams. Because the management team, the company could change 100%. IBM was a typewriter company. They saw the end of typewriters and moved into electric typewriters, and they went from electric typewriters to computers and so on and so forth, because their electric typewriters were, they understood the business. The business is what you need to do to make documents, right? All the world ran on documents at the time, and they saw it coming, and they were willing to adapt and to invest and do what it took, because they went from the IBM to the electric typewriter. They went from the electric typewriter to the memory electric typewriter. Remember, they had those tiny little screens, and they would actually have little memory chips, and you can go back and it would, or you type a whole sentence out and it would check it, and then it had spell checkers in it. These were little teeny tiny mini computers. Very, one function things. They were word processors. But as they expanded that, then they go boom, and then it goes into word processing. Then they started doing the mainframes, and people would be hooked up to the mainframes. Then they realized that the PC, they were slow on the PC thing. They eventually got into the PCs. But they were right. And again, see, I identify with IBM. They were right. They said these PCs are bullshit. They're not the future of computing. Centralized computing is the future of computing. It doesn't make sense to try to have the processing power at the PC level. And they were absolutely right, because that's what the internet is. The internet is putting the processing power in giant centralized computers, and we just use our PCs to access the internet for the most part. So IBM was always right, and in the grand scheme of things, they could have skipped the whole 20-year, wait, what year is this? 2020. So from 1985, 84, 85, so from the early 80s until today, 40 years, they could have just sort of skipped this whole thing and kept working on their mainframes. Because, we're back to the old model. We're back to the old model of centralized computing. So I know they would have missed out on some fun, but they might have had a much more kick-ass sort of web. They may have owned the cloud if that were the case. But anyway, the point is the management adapted and changed and went with the flow. Even if they were reluctant to do so, they went with the flow to keep the company in the forefront of computing, even when they thought the forefront of computing, which was PCs, was stupid. They still went with it. And don't forget, they sold their PC division to Lenovo years ago, because they were done with it. They were like, this is over. So when Buffett buys the company, he's looking at the management team, and he wants smart guys who are adaptable and are going to be there for the long haul, and are going to take the company whichever way it needs to go. And you don't know what that is. Believe me, you look at business plans, and these business plans say this and that, and then 2 years later, you don't even know, you could not even tell that company had that business plan. You're like, what the hell? That's not at all what you said you were doing. It's up to It's up to us when we're investing in companies to find the companies that are able to adapt and thrive and move forward. So, you know, I look at these guys, I think of the times, I think of the macros and so on and so forth. So today, I was looking in the bargain bin, and for me, of course, the bargain bin is companies that have good returns on investment. I looked at VTRS, and I had forgotten actually that this company existed. They were only just formed as such. They came out of Mylan Labs and Pfizer, and they were Upjohn, which was their partnership, and they make medicine, and the medicines they make are a lot of shit. Oh, here they are. So Lipitor, Norvasc, Lycra, Viagra. Mylan is just a huge drug company. They're you know, you don't think of them, but they're EpiPens and AIDS stuff and all sorts of things. I mean, they just really great steady stuff. And while we're here, I can do this. So what did I say was, oh, 16, let's say $17 billion. Look at this freaking money. You know, nobody's done the math and figured out what this company now does. You know, the analysts have not looked at this at all. It's fallen off the radar. And it's because they did this combination thing. They restructured themselves last year when nobody was paying attention. And so now they've got these drugs, they're making these sales, they're making $4 billion a year. Their PE is 4 at the moment. They have a big debt load to pay off. That's why it says bankruptcy risk. But the bankruptcy risk is unrealistic if you're servicing your debt. That's the problem. When you see things like that, you have to understand how they got to that number and what it's made of. And the thing is, they're totally servicing their debt with their cash flow. It's not an issue. And in fact, I think they're paying off, I believe it's $1.6 billion worth of debt by the end of next year, which is probably about 20-25% of the debt is being paid off next year. So that will suddenly change this thing from here to probably into the green, which is obviously their goal. They want to get back to having a AAA credit rating. But then they're going to be the same exact company, but just with a better score on the credit. And all of a sudden, there's a lot of investing funds that cannot invest in them because their Z-score is low. You know, if you're below a certain level with a lot of companies, they will not invest in you. They're mandated to stay away. It's a great company. People think their stuff is going off patent, that they're diminishing returns, blah blah blah. But that's not what management's talking about. They've got growth plans. And again, you're working off such a low base that even if they didn't come up with anything else to sell, you're still going to have many years of ridiculously good returns for this price. So that's where this pick came from, and I made that a top trade alert, and people are buying it already. And we put that in the long-term portfolio. We bought the shares for the dividend portfolio, 2,000 shares, because they pay a nice dividend, 44 cents on 14 bucks is pretty good. But we're not paying 14, we're paying 14 minus 2 minus 2. So we're going to pay net 10 because we're selling the $15 calls, which are up here. All right. So we're selling the $15 calls. So we get called away at 15. We're selling the $12.50 puts because we'll be very happy to buy more for $12.50. And what does that do? That effectively drops our basis to $10. So if we have to buy 2,000 more for $12.50, our net is $22.50 divided by 2 is what, $11.25. So we would be spending net $11.25 for 2,000 shares, and 2,000 shares. So 14 minus 1.25 is 275 divided by 14 is 20% off. So that's, you know, usually where we're going to fall. So we'll be buying the stock in our worst possible case for 20% off 1408, and we'll have 2,000 shares. 4,000 shares. Sorry, we'd have 4,000 shares at whatever the heck I just said, 20 at 11.25. So 4,000 times 1.25 is $45,000. That's what we're committing to, is to owning $45,000 worth of stock. Ordinary margin account should be divided by 2, should be $22,500 of margin, of ordinary margin taken up in a trade like this. Now, what are we spitting out off that 22.5? Well, if we do get to 15 with 2,000 shares, we're going to be, and that's our total commitment, okay? If we do get called away with 2,000 shares at the $15 level, that's $30,000. So how much we make? $7,500. That's off our commitment, not off our cash. Cash is only 19.8. But even off our commitment level and the margin required for that, that's what we're making. If 4,000 shares, oh yeah, I'm sorry, that's the margin commitment level, not the cash commitment level. And of course, you got the dividend coming in as well. But so you make 7,500 here. We're going to make the dividends going to be the same 880 no matter what. So we're making 880 here also, and on an annual thing, which is another 5% basically, or 4% on an annualized basis. So between the $7,500 profit, which is 30%, and the other 4% is 34, and then probably 2 more is 36. So about 36% over 18 months is 2% a month is the profit on this trade against your entire margin commitment. You know, and this is how we make the money. Now in the long-term portfolio, I said screw that, because we can, for 4,800 in cash, we're making the same exact commitment on the put side to buy 2,000 shares. Same commitment, although we're not buying 2,000 shares. We're creating an artificial 5,000 shares at 12.50. And 12.50 is lower than it is now. And we're going to cap it a bit higher at 17.50. We could have been more conservative and capped it at 15, but we think this is like way underpriced. So we're gonna go with it for the long term. Not only that though, but keep in mind that 15, we're still gonna make 250 times 50, which is a number. 250 times 50 is what? 12.5? Whoops. 250 times 50. 12.5. So we're still gonna get 12.5 back at the same $15. 12.5 is an $8,000 profit here. So we're fine with that, but we keep going up to making as much as 21,000 something, 20,200. So we could make as much as 20,200. We're not capped at 12.5, but the point is, even at the same number, we're going to make some pretty good money. And again, in a long-term portfolio, we can do that. And as I wrote here, I'll be very thrilled to see these guys drop down to this level and we can start buying more and turn it into a proper trade. I'm like, oh yeah, I'll take that assignment at 12.50. I don't have a problem with that. And after I'm assigned, if it goes lower, I'm very happy to buy more. And then we could sell some calls and sell some puts and be happy, happy people. That's what you want to look for in a trade. It's like the worst case doesn't bother me at all. Wow, these guys are popping too. I wasn't looking at Apollo. I was looking at ATH, and ATH is getting bought by Apollo, and that's kind of keeping a lid on them, since Apollo's already said we're buying you for this price. But Apollo is buying them for shares, not for cash. So Apollo is giving them 1.15, I think it is. I must have written that somewhere. 15%, yeah. So you get 1.15 shares of Apollo, which is actually at 60. And these guys are at 65. So 1.5 of 6 is 9. So you're getting basically a bit more than 67-ish if you consider this cash. But there's a dilution factor and so on and so forth. So these guys are kind of mirroring each other because this deal's done. It's signed and it goes in Q2. So it doesn't matter what price Apollo's at, you're going to get your 1.15 shares if you own ATH. Now, I didn't want to get ATH, but well, first of all, because it's going to disappear, but also because it's the options suck on APO. No, I'm sorry, the options suck on ATH. So APO is still playable. They have nice fat premiums on the options, and we were able to construct this trade that's going to make 270% in 18 months, and all it has to do is get back to 65. And again, as I said, the combined company is going to make, where did I write that up? ATH makes $2 billion. Apollo makes $1.5 billion. Apollo is smaller than ATH. ATH is they manage retirement savings plans. They have much more money under management than Apollo, but they manage it more conservatively. But Apollo is no small potato. They're a major player. And so Apollo's logic and ATH agrees, and these are very conservative companies that are seeing something. So Apollo's saying, okay, I tell you what, let's take your money, manage it under our strategy, and instead of making 5% a year for your people, you make 10%, 12% a year for your people. They're going to be happy. The customers are going to be happy. We're a little bit more aggressive, but we're still in the bounds of a conservative portfolio. And your people will be happy. And meanwhile, we're going to take this fat $2 billion worth of revenue and up it by probably 50%. The fees, the increased fees from success will up this revenue by 50% or more, and it won't change Apollo much. But instead of making a combined 3.5, they'll make $4.5 billion a year in profit. And again, we're still talking about a combined market cap of 25 billion. So they're going to become incredibly undervalued. And all we need here is for that to prove out. So if that proves out and they start showing success and they start running good numbers and so on and so forth, people are going to be jumping all over this thing. But again, that's how you find markets. You have to look for things that other people are overlooking. And you have to think about, why is this undervalued? It's easy enough finding a stock that in theory has a low PE, but there's really good reason some things have a low PE. You've got to be very careful about, why does it have a low PE? What's the story here? So in this case, the story is you have this merger coming up, or technically it's an acquisition by Apollo of all stock. There's no cash involved. People don't like that. They don't know what the integration will be like, so on and so forth. So you have to really dig into that and read what the management's doing and so on and so forth. Once you decide you like it, you want to make sure the numbers make sense and everything's working and so on and so forth. And then we sort of try to make a tentative position that gets us into it. And again, it goes back to the same thing. What's my worst case? Can I live in my worst case? My worst case is I'm buying Apollo for 50 bucks. Okay, so I'm going to buy $58 Apollo for 50 bucks, which is down here, which has a consistent solid range. And it seems like a reasonable price. We're actually spending $8,100 though, so it's really going to be 1,000 shares. It's going to be $58, not 51. So we're really buying Apollo for the current price. Can I live with that? Yes. What if it drops to 30 bucks? Will I be happy to buy more and average, $45-ish on Apollo? Yeah, I like $45 is a good price. I don't really want to own 2,000 shares. I'm more likely to try to roll out of trouble if something like that happens, because 2,000 shares is obviously a lot of money. It's going to be 100,000 bucks. So I don't know if I'd want to jump in and immediately grab it, but I can live with it. I can live with having $100,000 of Apollo. It does have very good dividends. It'll have premiums. It'll have much better premiums if it starts falling also. And then, do we think 65 is a realistic target? Yes, we do. What happens if it stays hovering around 55? Well, we have the $50 calls. We have 20 of them. That'll be $10,000. We're spending $8,000 on the spread. So even if it stays at $55, we have a profit. Not a good one, but a profit. And of course, that's Warren Buffett's rule number one: do not lose money. If you follow that rule, you will do very well. Then we looked at WBA. That's me banging the table, always on WBA. And Coca-Cola we were looking at. And, oh, that was just a question about like deploying Coca-Cola, so that's not important. And that's it. All right, so that's where we are there. Let's see if anybody has any questions. We got to wrap this up. Why is WBA having such a rough time? Earnings are good, guidance is good. The WBA is okay. It's also a stressed out company. They expanded. They bought out, for the most part, they bought out Rite Aid, and of course Walgreens and Boots merged, which puts them here. Okay, they appear to be risky. Realistically, it's insane. This is a $40 billion company making $4 billion a year, and it's rock solid. 117, 118, 131, 136, 132, 131, 136. Okay, not a lot of growth, and not a lot of growth in profit. 4 billion, 4 billion, 4 billion, 5 billion, 4 billion, 4 billion, 4 billion. Oh no, only 4 billion a year. I'm only paying $40 billion to make 4 billion a year. They're going to keep making 4 billion a year, so eventually they'll come into favor, and people will pay 12 times earnings, 15 times earnings for them. Right now, they're out of favor. And they could go more out of favor. They could go to 8 times earnings, but below 8 times earnings is just insane. It would take another real crash for that to happen. So I feel very comfortable buying them down here. I feel very comfortable adding to them down here. And when they get back up to here, I'm going to be very comfortable selling calls because I don't think they should be higher than 55. It's just not that kind of company. It's a boring, low growth, practically zero growth company that just took on a big acquisition of Walgreens and then Rite Aid. They did it at just the wrong time because they weren't able to accomplish what they want. They were closed for a year. So don't forget that they're still in the acquisition mode. They acquired they merged with Walgreens and Boots, which is a European version of Walgreens. They merged. They started turning all their stores into like 7-Elevens, basically, with all kinds of stuff in it. At the same time, then they bought Rite Aid. They had to divest a large portion of the stores that they bought, but they kept the ones they wanted, really. But they weren't, because they would have been too big. They're at the size now where they're almost too big, and the SEC and the FCC is cracking down on it. So they had to divest a good portion of the Rite Aid stores they bought, but they kept the ones that they kept the good ones. So that's fine. But what they didn't have is last year, in the middle of starting to get these renovations done and upgrade all the Rite Aid stores and so on and so forth, the pandemic hit and everything closed. And yeah, of course, the pharmacies are open and whatever, but they weren't in any kind of shape to redo stores and do what they wanted to do. It all went out the window. And now they're just trying to sort of breathe and recover and get back on track. But even during the pandemic, they didn't lose money. And they're right back on the horse and back to hitting $4 billion in revenues. Not only that, though, but they're really underestimating their own growth because the COVID's almost certainly going to need a booster shot. And right now, I don't know how your states were, but in Florida, we went to I didn't even know what it was. I mean, it was some kind of municipal building of some sort. I don't know what it was. But we went to this place, and there were like 25 people giving you shots in 2 rows. And you went and got on the line and sat down on the chair, and they gave you a shot, and you went out. It was like an army thing, like next boom, next boom, next boom. It was very well run. Much as you might criticize Florida for stuff, and much as the governor thought the whole thing was a hoax, it still was done properly. And they cranked this through, but that's not going to happen next time. They're not going to do it that way again. When we go to get our booster shots and our renewal shots and whatever, which we're going to be doing probably for the rest of our lives, you're going to go to the pharmacy or your doctor or something like that, but you're going to get lots and lots of people going to be at Walgreens. In fact, every time I'm at Walgreens now, every time I have to go there, there are people waiting for shots. All the stragglers now go there. There are no more immunization centers. You go to the pharmacy. When you go to the website and they say where to go, they're like, go to Walgreens, go to CVS, blah, blah. That's where they have the people sitting there. And those people come in, and lo and behold, when you're in for your mandatory shots, you shop. So now we have this 7-Eleven, Walgreens, whatever you want to call it, but now we have all these Walgreens that have all this stuff and candy at the counter and so on and so forth, and a waiting time where people are bored and have nothing else to do but browse around the store, and we're sending every single American into there. Not all to Walgreens, but everybody in America basically has to go get a shot now every single year at least. That's not in their business plan. That's not reflected. They're not really planning on it. And that's advertising free. That's coupon free. People are being sent to their store by the government, who is paying to send that person to the store. So they'll get a fee for the shot. They will get they'll get extra revenues from the people shopping. They'll start building habits where people start depending on them to go there for things. It's fantastic. So how you don't put money into something like this, I didn't even understand. So, it's just heavily out of favor. People think the biggest problem is people think this is a fad, that the COVID thing is done and they'll have a one-time boost and that's it. That's not what this is. They don't need COVID to get $4 or $5 billion in revenues. They don't need a disease to make that happen. They got one, and it's going to be boosting them in the future. And they'll get back to eventually $5 billion in earnings. And $5 billion in earnings on a $40 billion company is 8 times. And again, it may not grow, but we don't care if it grows. We care if it's steady. If it doesn't grow, we're very, very happy to sell. And again, here, Walgreens is so it's $46 now. We don't think it's going to go over 50. Now, we don't own it. We have artificials, but even if we owned it, this is only 60 days out. Oh, here's 90 days out. Okay, so October is 90 days out. So for 1 quarter, we can sell, it's at 46, we can sell the $50 calls for 90 cents, for $1 basically. It's 2%. And if we own the stock and we sell calls that are $3 higher, so they are 7% higher, and we collect 2%, what's the worst case that happens? We make 9% and we get called away in a quarter. That's our worst case to the upside. If every quarter our risk is 9% and we're putting 2% in our pocket every quarter, and maybe we get called away eventually and get the 9%, so that means the minimum we're going to make every quarter is 2%. That's an 8% return on our investment, on our boring investment that goes nowhere. And if it does go somewhere, we get a bonus 7% the quarter it goes somewhere. Why would I not want that in my portfolio? You guys are really spoiled. We do too many stocks, we do too many spreads that give you 300% returns. In reality, for most investors, 2% a quarter is fantastic money. We're doing that in our hedge fund. People are freaking loving it. We give people back 2% every quarter because we have the investing fund. And that's exactly how we do it. The other money is a bonus. When we make money in the longer term, that's bonus money. But what we are making is 2% that you can rely on as an income on a quarterly basis. And that's fantastic. People who are retired, people who have money that they don't want to diminish the money that's in their retirement account, and they want to live off it, when you can pull down 8% a year, that's all most people need. If you haven't, and then the growth behind it, if we add to that, like in the second half of last year, we were up 15% total, even after the distributions. So 2 distributions. We started middle of last year. So 2 distributions of 2%, plus we were up 15% overall. So 19% really in the second half of last year. It's a second half loaded fund. So this year, first half, we're pretty flat, but that's because all these trades are end of year trades with the expiration. So they accelerate rapidly into the end of the year. So it's actually kind of a good time to get in now. But that's, so that's how it works. It's all about, can you give yourself an income? Are you going to be able to generate cash, so on and so forth? And, I know we tend to do more aggressive stuff and whatever in the long-term portfolio, but honestly, it's the intention is to just go for the 2%, 10% things, and then it works out better. Like let's go back to Viacom, more table bangers. But you look at Viacom, and this is another stupidly underpriced stock. It's $41.37. I can sell the $40 calls. I forget that. I can sell the $30 calls for $5, $5.25 at least. For the 35 calls, that puts me in at net at net 30, below net 30, 25% off the current price. This is a mindless investment. How many shares of Viacom would I like to own? I think we already have it as a stock, and if we don't, we should. Valero Viacom, there it is. Okay, so we already have an aggressive play on Viacom because we have 30 longs and only 10 short calls. But we sold the $40 puts. We were more aggressive. We sold the $40 puts for $12.30. Now they're $7.45. We're up 40%. We're up $5,000 on the short puts so far, and we're not really in danger. We're not worried about it. What did this? We're at 40. So what did this? Time. We sold them in March, and now it's August, so it's 6 months later. And 40% of the price, 40% of the value of these short puts is eroded. Part of it because the price increased, and part of it because the time decreased. But that's a fantastic way to make money. All we're doing is promising to buy Viacom if it gets cheaper, and we get paid for that. So yeah, what's my intention? My intention was to own Viacom. And then play it from there. We're not going to end up owning Viacom. We're going to end up getting the short puts will expire worthless most likely. And on these long calls, we've got these long calls, and we're up only very, very slightly on the long calls, but we already sold some short calls and bought them back because those made money. And in fact, these short calls are up 86%. The only reason we're not buying these short calls back is because it's stupid to. Why should I give them even $885 because it's going to expire in January and they're 60s? Viacom would have to go up 50%. And since I'm only 1/3 covered, if it goes up 50%, I'm not going to cry that 1/3 of my stock got called away at that price. In fact, I'd be selling it anyway if it hit 60. So there's no losing to this at all, and so there's no reason for me to pay $1,000 not to have that cover. Doesn't cost me margin, doesn't cost anything. The only way it costs me anything is if I get out of it. Otherwise, I'm going to make that $885. There's no way it's not going to happen. And again, income fund. How much net was this trade? Again, we already took a profit, but 39 minus 12 is 27, right? Minus 7 basically is $20,000. $20,000, $885 by January, which is what it even says it's 6 months. So in 6 months, out of $20,000, it's almost 5%. It's 4%. It's more than 4%. That's good money. That's better than if I had the cash in the bank. I could sell calls. I could sell more calls. I could sell more puts. I could do a lot of things with it. But at the moment, we think Viacom is stupidly underpriced. Wherever they are. There it is. Huh? So, you know, I'm not selling and I'm not covering here. I'm waiting for it to get back to 60 and then I want to cover. And we'll see what earnings are and so on and so forth. But look, they're popping 2.35% today. That's very nice. It's slow, it's tedious, but we're going to own it for 18 more months. Not own it, but we have the $30 calls. That's as close to owning it as I usually get. That's a deep in the money call. And we paid that money because we want that high delta. We want to make all the money on the way up. But that's how we go, you know, that's how we adjust our portfolio and that's how we go through it. And that's how we build up these winners. We're not like swinging for the fences here. When we went into Viacom in March, we bought the $30 calls for $13. That's net 43. We sold the $60 calls. We thought it would come back. It has not come back. It's been honestly disappointing. But still, it doesn't change our valuation. So we came in here and said, oh my God, look how cheap Viacom is. And we said, well, we think it'll get back to 60. Oh, it hasn't done crap since then. Still think it'll go back to 60. It's just going to take longer. But we've only had it for 6 months. It's an 18-month trade. Actually, it was a 24-month trade at the time. Oh, okay. I gotta go. All right. That's it. So we're in good shape. Everything's fine. How's the market looking at the moment? Whoops, what the hell is that? Oh, Viacom. Damn it. I can't get used to that. Looking for the Dow. Dow. There we go. Oh, wow. 245 today. I mean, everything has just recovered like crazy. You cannot make this market stay down. It's really amazing. Well, all right. So like I said, I'm going to be in Orlando next week. There will not be a webinar, but we will be in the chat room and we'll talk about it. And I'm going to be still looking for some more bargain stocks, just so we have something else to put in the long-term portfolio. Oh, that's one thing. How is that? Is this a long-term portfolio? It is. So look at this, up 36,000 today. The long-term portfolio. Remember, it was up 60 yesterday. Now it's up 36 again. And hopefully the short-term portfolio didn't lose 36. Oh, Jesus. Wow, it did. Lost 56. So not a good day for the short-term portfolio. Holy crap. What on earth was that? Oh, Chipotle killed us. Look at Chipotle. So it all came off of Chipotle. Holy cow, that is nasty. But anyway, so the bottom line is we're even. We're back. We're right back where we started last week. And of course this will be, you know, this will wash back out. But holy shit with CMG. Oh my God. Well, there's not much you can do when that happens, right? When you're short. Holy crap. What is that about? All right, extended webinar time. Let's find out what the hell that is. Let's see what Seeking Alpha has to say on the subject. CMG. Oh. Wow. Passing costs on to customers. They love that. Topping estimates 30%. Yeah, but it's 30% off the pandemic. That is so annoying. Still, I'm sure these are really good numbers. So Q2 non-GAAP EPS of 7.46. So they're making $15-$30 a share. And the shares are 17, blah, 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 whatever, 1773. So 1773 divided by 30, still a 60p. It's still insane. That sucks. That's really annoying though. Holy cow. So we're gonna have to adjust basically. I mean, we're gonna take this position, and we've got the short $1,500 calls. We sold them for 72. We're down $200 there. That's where we're getting killed. 60. There's our entire loss. So we're down $200, but we're gonna roll them. And I'll show you where it is. It's a CMG. Oh, so annoying. These are $1,500 calls, and they are now 275. And if you look at January, so what you want to do is look and see who's 275 in January, and that would be, well, we don't want to be in the 16s, so we're going to be at 17. So the 17s are 180. So that's not a terrible adjustment. So basically, we would roll to like the 180s. And by the way, we could roll and we could sell, since this is 180 and we wanted 270s, we could also sell a couple of puts to balance it out. Can't lose on both. The only thing is I really can't see selling a Chipotle 1550 call, 1560 put for $60, because I really strongly believe they'll be lower than that. So it's a little tricky. But we'll see if they calm down. If they don't calm down, we'll have to set up a roll. That's all there is to it. And we can also buy some longs. But again, then we're turning the position into something I don't really believe in. I don't like to do that, but defensively you have to at a certain point. So we will see what happens there. And I'm sure we'll be talking about that before before the next options expiration period, because that definitely has to be adjusted. All right. Well, thanks everybody for coming. I appreciate it. And we will do it again in 2 weeks. All right. Thanks a lot. Bye.